Imagine a company that generates over $16 billion a year.
Yeah, that's a massive top line.
Right. And they hold the medical data of roughly 1 out of every 8 human beings on Earth.
Which is just staggering when you really think about the scale of it.
It's wild. Plus, their order book is absolutely bursting with $32 billion in future business. You look at those numbers and, you would naturally think their stock is completely bulletproof.
You'd think it's the safest bet in the market.
Exactly. But today, we are going to explain why one slight change to a privacy law, or a tiny shift in biotech funding, or even a leap in open-source AI could send this exact company falling off a cliff.
Yeah, because it is the ultimate illusion of scale. I mean, the market looks at a dominant market share and just assumes stability.
Sure.
But when you look closely at how that market share was bought and, the massive pile of debt financing it, you realize the foundation is incredibly sensitive to the slightest macroeconomic tremor.
Welcome to this deep dive. We are so thrilled to have you sitting right here with us as the third person in this conversation today.
Glad to have you here with us.
Our mission for this deep dive is highly specific. We are evaluating whether a massive healthcare data and clinical research company named IQVIA, ticker symbol IQV, is actually a good investment right now.
Right, and to do that, we are dissecting a really comprehensive, skeptical buy-side deep dive memo.
And we should clarify, the objective here is not to just read you their glossy investor presentation.
Oh, definitely not. We don't want to just list their quarterly earnings. We want to uncover the structural, the competitive, and, the regulatory realities hiding beneath the surface of their SEC filings.
Yeah, we're looking for the exact mechanisms that drive their cash flow. And more importantly, the mechanisms that could suddenly choke it off. Okay, let's unpack this. IQVIA generated $16.31 billion in revenue in 2025.
Right.
And they are sitting on an incomprehensible 68 petabytes of healthcare data.
Which is, it's hard to even visualize that number.
It really is.
Yep.
To put 68 petabytes in perspective for you, if you took every single movie ever made in high definition, you wouldn't even scratch the surface of a single petabyte.
Wow.
Yeah. They are holding the digital equivalent of an endless library of human health information. But, and this is the massive but that anchors our entire conversation today, they have a heavily levered balance sheet.
Highly levered.
And they're operating in a rapidly shifting AI landscape. So the question is the current stock price a trap, or is it a launch pad?
Well, to determine if this stock is a trap, we first have to understand the gap between what the broader market is currently pricing in versus the reality of how this company actually operates on a day-to-day basis.
Okay, lay it out for us.
So to do that, we need to talk about what IQVIA actually does. They are a massive global provider of clinical research and commercial healthcare intelligence.
Right.
And out of that $16.3 billion in revenue, they generated roughly $2.18 billion in GAAP operating income.
Which is a solid number.
It is. But the number that the market really fixates on, the shiny object, is their backlog. They boast a contracted backlog of $32.7 billion in their research and development solutions segment.
$32.7 billion.
Yeah, and they expect about $8.3 billion of that to convert into actual revenue over the next 12 months.
Hold on. Let's ground this for anyone who doesn't, spend their week modeling pharmaceutical supply chains. What does this business actually look like in practice?
Sure, let's walk through an example.
Okay, so let's say I'm a brilliant scientist. I just invented a revolutionary cure for a rare blood disease.
Okay, congratulations.
Thank you. Now, I'm a genius in the lab, but I am absolutely not an operations manager. How do I actually get this drug approved?
Right, that's the bottleneck.
I have to find 300 people scattered across 40 different countries who actually have this specific rare disease.
Which is incredibly hard.
I have to get them the experimental drug. I have to track their vitals every single day, monitor their side effects, and then package all of that data perfectly legally for the FDA.
Yeah, it's a massive undertaking.
That logistical nightmare is what a contract research organization or a CRO handles. IQVIA does that heavy lifting.
That is the perfect illustration. IQVIA provides the physical and digital infrastructure for drug development.
Okay.
Now, the skeptical premise of the memo we are analyzing today doesn't dispute that IQVIA provides a vital service. They are deeply embedded in the pharmaceutical ecosystem.
No one is saying the business is fake.
Exactly. The core question is whether their current valuation, which sits around $166 a share, properly discounts three massive variables.
What are the three variables?
First, the inherent volatility of that CRO cycle you just described. Second, the potential regulatory erosion of their massive data advantage. And third, their enormous debt leverage.
Let's poke at that $32.7 billion backlog first. Because when I hear $32 billion in contracted backlog, my brain immediately translates that to, well, guaranteed money in the bank.
Right, which is exactly what management wants you to think.
But treating this backlog like a guaranteed paycheck feels incredibly dangerous to me.
Yes.
It feels more like a pencil booking at a hotel. Like you can reserve a block of 50 rooms for a wedding a year in advance, right? And the hotel gets to brag to everyone about being fully booked.
Yeah, look at our pipeline.
Exactly. But if the couple breaks up, or in this case, if a biotech client's venture capital funding suddenly dries up, they can just call the hotel and cancel the reservation.
The hotel analogy captures the exact risk profile here. A skeptical valuation requires you to view that backlog as supporting evidence of future demand, absolutely not as guaranteed revenue.
Not a sure thing.
Not at all. In fact, IQVIA explicitly warns in their own SEC risk disclosures that they typically have no contractual right to the full amount of revenues reflected in their backlog if a client cancels a trial early.
Wait, really? No contractual right?
Yeah, the conversion rates, meaning how fast that backlog actually turns into cash, they vary wildly based on the mix of projects, regulatory delays, and, well, scope changes.
So underwriting IQVIA is a long position like. If you're buying the stock today hoping it goes up, means you're making a very confident, multi-tiered bet.
You really are.
You are betting that the demand for outsourced clinical development is going to accelerate, that cancellations will remain historically low, and crucially, that their massive debt load will remain manageable.
Yes, and we need to put a massive spotlight on that debt before we go any further, because honestly, it colors every single decision the company makes.
Here's the number.
The sheer scale of the leverage is staggering. At the end of fiscal year 2025, their total debt sat at over $15.7 billion.
Wow.
Yeah. Compare that to just under $2 billion in consolidated cash on their balance sheet.
$15.7 billion. That's not just a line item. That is like a gravitational force pulling on the entire company.
It is. And when you carry that kind of leverage, your margin for error shrinks to almost zero.
Right, because you can't just coast through a bad year.
You simply do not have the luxury of absorbing a bad macroeconomic year. If there's a sudden wave of trial cancellations because interest rates spike and, say, biotech startups can't secure funding...
The debt doesn't magically pause.
Exactly. The interest payments are due regardless of what is happening in the broader economy.
Which naturally begs the question, how did they get $15.7 billion in debt in the first place? I mean, that money didn't just evaporate.
No, it was spent.
It was largely built by acquiring the massive assets and the data that make up their core business model. So let's transition into the business overview and look at what they actually bought and whether the so-called moat around those assets is truly secure.
Sure. So the foundation of IQVIA rests on two main pillars, supported by roughly 93,000 employees globally.
Okay, pillar one.
Pillar one is research and development solutions. This is the clinical trial execution you described earlier, finding the patients, monitoring the sites, running the clinical protocols.
Got it. And the second?
The second pillar is commercial solutions. This segment provides the data, the software, and the real-world evidence to help pharmaceutical companies successfully launch, market, and sell those drugs once they are actually approved.
So the connective tissue linking the trial phase and the selling phase is their data.
Precisely.
The memo highlights that IQVIA has a proprietary health data footprint covering about 1.2 billion non-identified patient records.
That's right.
They are ingesting something like 120 billion healthcare records annually from 150,000 different global data suppliers. That is the 68 petabytes we talked about at the start of the show.
And the investment narrative here, like the story that Wall Street is paying a premium for, is all about integration. IQVIA's pitch to a massive pharmaceutical sponsor is essentially this. Because we have this unparalleled connected data ecosystem, we can design your clinical trial faster and cheaper. We know exactly where your target patients are located.
Okay, that makes sense.
And then once your drug is approved, you don't need to hire a separate marketing analytics firm. We will just use that exact same data ecosystem to tell your sales reps exactly which doctors to target.
Ah, so it creates a massive workflow lock-in.
Huge lock-in. Once a pharma sponsor embeds IQVIA's data into their pipeline from start to finish, ripping it out to switch to a competitor just becomes a logistical nightmare.
It's like building your entire city's transportation network around one highly specific proprietary type of train track.
I like that analogy.
Right, because once the rails are laid down, you're stuck buying trains from that one vendor forever.
You have no choice.
But the memo points out a massive, almost existential vulnerability hiding in plain sight here. This data moat is actually incredibly fragile because it exists entirely at the mercy of global regulators.
Yeah, the entire business model relies on the legal definition of de-identification.
Explain that for us.
To legally harvest, aggregate, analyze, and sell insights based on 1.2 billion patient records across dozens of countries, that data cannot be tied back to an individual person. It absolutely must be legally classified as anonymous.
But the definition of anonymous is moving, isn't it?
Right.
Privacy laws in the European Union, in California, and across the globe are getting drastically stricter.
They are. Consider the actual mechanics of it. De-identification isn't just, deleting someone's name from a spreadsheet.
Right.
You have to remove birth dates, specific geographic locations, and unique medical anomalies. But as data analytics become more sophisticated, the risk of what's called re-identification increases.
Meaning someone could figure out who the data belongs to.
Exactly. If you combine an anonymous medical record with a separate anonymous consumer purchasing database, an algorithm might suddenly figure out exactly who that person is. Yeah. And if regulators decide that the current standards for de-identification are too weak, IQVIA faces a brutal choice.
Let me guess. Either their compliance costs skyrocket to meet the new regulations, which completely crushes their profit margins,
Yeah.
or they have to strip so much detail out of the data to keep it legal that the data actually loses its value.
That's exactly the risk. If the data is too generalized, they can't offer those granular premium insights to their clients anymore. Both of those scenarios destroy value.
This raises an important question about the role of artificial intelligence in all of this. Because IQVIA has been heavily promoting a narrative around healthcare-grade AI.
They talk about it constantly.
They argue that injecting AI into their connected intelligence platform will automate manual tasks, speed up clinical trial cycle times, and drastically reduce their own operational costs.
And there is truth to that on the cost side.
Sure, here's where it gets really interesting, though. I can totally see the operational upside. But if open-source AI models get cheaper, smarter, and incredibly ubiquitous, doesn't IQVIA's proprietary data become their only real asset?
You're hitting on the core of the bear thesis.
Let me push back on the bull case here for a second. If I'm a pharmaceutical giant, and I can just download a nearly free, genius-level open-source AI model, why do I need IQVIA to analyze anything for me?
Your pushback hits on the exact mechanism of the AI threat. Think of IQVIA's analytics team historically like a master translator.
No.
They were the only people in the village who could read ancient Greek, which in this case is the raw, messy healthcare data. Because they were the only ones who could translate it into actionable business insights, pharmaceutical companies paid them an absolute fortune.
But open source AI is like handing every single pharmaceutical company a flawless universal translation app on their phone.
Precisely. Suddenly, the pharma company just wants to buy the raw Greek text, the raw data from IQVIA, but they refuse to pay the massive premium for the translation service. They can just run the analytics in-house.
And that completely destroys the barrier to entry for analytics.
IQVIA explicitly flags in their SEC risk disclosures that third-party AI platforms could reduce their differentiation.
So they know it's a threat.
Oh, they know. If a client can buy raw data from a cheaper broker and use an internal AI tool to generate the exact same insights IQVIA used to charge millions for, IQVIA's pricing power simply evaporates. AI is simultaneously a tool for internal efficiency and a wrecking ball to their high-margin analytics business.
Wow. So if this precious data moat requires constant investment to protect against AI and heavy legal spending to keep up with privacy compliance, how efficiently does IQVIA actually translate its $16 billion top-line revenue into actual tangible cash?
That's the million-dollar question.
This brings us to their historical financials and what the memo refers to as the margin reconciliation gap.
Right, so from a high-level historical perspective, the growth looks quite solid. Over the last decade, their revenue grew at a compound annual growth rate, a KGR of roughly 11%.
That's a great growth rate for a company that size.
It is. Furthermore, their cash conversion has been structurally strong. Free cash flow has frequently exceeded 10% of revenue since 2020. If you stop your analysis right there, this looks like a beautiful asset-light cash printing services model.
But we aren't stopping there,
We definitely are not.
because we hit a massive, glaring speed bump in their fiscal year 2025 numbers. Depreciation and amortization, commonly referred to as D&A, was a staggering $1.44 billion.
Over $1 billion.
Let's stop and look at that number. I don't want to gloss over this as just another spreadsheet metric. Why should a potential investor care about a $1 billion depreciation figure? What does this actually mean for long-term value creation?
What's fascinating here is how this single line item exposes the two completely different realities of IQVIA's business.
What do you mean?
Management strongly prefers to direct investors' attention toward their adjusted metrics. When you look at their segment profit margins, which conveniently exclude this massive amortization charge, they look phenomenal.
How phenomenal.
The technology and analytics segment boasts roughly 24% margins. The research and development segment sits around 21 to 23%.
Those numbers paint a picture of a sleek, high-margin software business.
They absolutely do. But the GAAP numbers, the generally accepted accounting principles numbers, which are the standardized rules everyone actually must follow, they tell a much more sobering story.
What's the gap story?
The GAAP EBIT margin, which is earnings before interest and taxes, for the whole company is significantly lower. It's hovering around 13.4%.
That's a huge drop from 24%.
Yeah. The massive delta between the rosy adjusted numbers that management loves and the sober GAAP numbers is the reconciliation gap. And the vast majority of that gap is driven by that $1.44 billion in amortization of acquired intangibles.
Okay, let me play the devil's advocate here, because Wall Street analysts often wave away amortization as just past M&A noise.
They do it all the time.
The argument usually goes, hey, we bought a software company 5 years ago. Writing down the value of that software over time is just a non-cash accounting fiction. We already paid for it. It doesn't affect the cash we are putting in the bank today, so just ignore it. Why is the memo arguing that this is a very real economic cost?
To understand why it's a real economic cost, you have to walk through the life cycle of their specific strategy. Let's look at a hypothetical scenario.
Okay.
IQVIA buys a regional data broker for $500 million to get access to, say, a new set of European patient records. Under accounting rules, they slowly amortize or write down the value of that data asset over the next decade.
Right, and Wall Street says, ignore the write-down, it's a past expense.
Exactly. The check has already cleared. But here's the problem. The data they bought doesn't stay fresh forever. Contracts expire. The software they bought gets outdated. Competitors emerge with better data sets. To maintain their massive data moat, IQVIA cannot just buy assets once and rest on their laurels.
They have to keep feeding the beast.
Yes, they are forced to continuously acquire new datasets, buy smaller, nimble tech companies to keep their platform relevant, and bolt on new capabilities. It is a heavy, capital-intensive roll-up strategy.
I see the mechanism now.
Yeah.
It's like claiming your household budget is incredibly healthy and you have a massive cash surplus every month, strictly because you decided not to count your mortgage payments or your home maintenance costs.
That's a great way to look at it.
Like, sure, you have cash in your pocket today, but the roof is going to leak eventually, the debt still exists, and you will inevitably have to spend capital to maintain the house.
That is the crux of the skeptical argument. If IQVIA is forced to continuously spend capital on new acquisitions just to maintain their baseline growth rate and defend their moat against AI and competitors, then that amortization isn't a one-time accounting quirk from a past deal.
It's the cost of doing business.
It is an incredibly accurate proxy for the recurring, very real cost of running their business. When management strips that cost out to present adjusted earnings, they are essentially asking investors to ignore the massive amount of ongoing capital required to keep their engine running.
And as we established earlier, they are funding this relentless acquisition engine with massive amounts of debt. Which brings us to a critical transition. They aren't acquiring these companies in a vacuum. IQVIA is fighting tooth and nail for market share in a massive, highly fragmented space.
Very fragmented.
Let's map out the competitive landscape and see how the market actually values IQVIA compared to its peers.
Well, the global pharmaceutical CRO market is expansive. It is expected to grow from roughly $41 billion today to about $63 billion by 2030, representing about a 7% compound annual growth rate.
Okay, so a growing pie. Who is fighting for a slice?
IQVIA is fighting a multi-front war. They compete against traditional pure-play trial executors like Icon and MedPace. They compete against massive consulting firms. And increasingly, they are going head-to-head with big tech behemoths like Oracle Health and Viva Systems.
Let's ground this with some peer benchmarking. How do we actually measure whether IQVIA stock is cheap or expensive compared to these competitors?
The standard financial lens for this is the EV to EBITDA multiple, enterprise value to EBITDA.
Hold on, for those of us who don't, spend our weekends building valuation models in Excel, let's break down EV to EBITDA.
Sure thing.
We aren't just looking at the raw stock price here. Enterprise value is like looking at a house. If you buy a house for $500,000, but it comes with a $300,000 mortgage that you have to take over, the true enterprise value of that house is $800,000.
Right, you have to factor in the debt.
Exactly. And EBITDA is essentially the raw cash the house generates if you rented it out, before taxes and accounting rules. So the multiple just tells us how many years of rent it would take to pay off the entire house and its mortgage.
That is an excellent breakdown. And the market assigns different multiples, different valuations, based on how clean, focused, and debt-free a business is. Let's look at the two extreme ends of the CRO spectrum to see where IQVIA fits.
Walk us through the spectrum. Who is at the absolute top?
On the absolute premium end of the spectrum, you have a company like MedPace. MedPace is a high-growth, pure-play CRO. They focus entirely on trial execution. Crucially, they have essentially zero net debt. They actually hold net cash.
No debt. Love that.
The market adores that clean, highly focused, unlevered story. Because of that, MedPace trades at a premium multiple of around 22 times EV to EBITDA.
Wow, okay, 22 times. And who is struggling at the bottom of the barrel?
On the far other end, you have a company like Fortrea. Fortrea is effectively a distressed turnaround story. They recently suffered a massive goodwill impairment, they are burdened with debt, and their revenue growth is stagnant.
Sounds rough.
The market heavily discounts that risk, so Fortrea trades at a multiple of roughly 8.7 times.
So we have 22 times for the pristine asset and 8.7 times for the distressed asset. Where exactly does IQVIA, the massive global behemoth with the proprietary data, sit in all this?
Right in the middle. IQVIA is trading at roughly an 11.1 times multiple.
Wait, why the middle? If they possess the most comprehensive data in the world, employ 93,000 people, and integrate both development and commercialization, why isn't the market rewarding them with a premium multiple closer to MedPace?
Because of the leverage and the structural complexity. A skeptical buy-side analyst looks at IQVIA and concludes, yes, your massive scale and your proprietary data assets mean you deserve to trade higher than a distressed failing company like Fortrea.
Right, that's fair.
But your $15.7 billion in debt, coupled with that massive recurring amortization burden we just unpacked, puts a hard ceiling on your multiple. We simply are not going to pay a pristine MedPace premium for a heavily indebted, highly complex roll-up.
This makes me question the core philosophy of their business model. Does being a massive conglomerate that spans everything from running clinical trials to selling commercial marketing analytics actually dilute their management's focus?
That's a really valid concern.
IQVIA pitches itself as the ultimate end-to-end partner. But does trying to be all things to all pharma companies make them a jack of all trades and a master of none? Are they deeply vulnerable to a nimble, pure-play competitor who entirely ignores the commercial data side, focuses 100% of their energy on, say, complex oncology trial recruitment, and just does it 10 times better and faster?
You are describing the classic conglomerate discount. The end-to-end integration story sounds fantastic in a glossy pitch deck, but the reality of execution is entirely different. Well, those two segments, clinical trials and commercial marketing, have vastly different sales cycles. They're sold to entirely different buyers within the pharmaceutical company.
Oh, interesting.
Yeah, the chief medical officer buying trial services does not care about the chief commercial officer buying marketing analytics, and they face totally different competitive threats.
Plus, the memo highlights a fascinating mechanical dynamic regarding how these large CROs secure revenue. There's a massive trend towards strategic partnerships.
Yes, the mega vendor trend.
Essentially, a massive drug sponsor like a Pfizer or a Merck will decide they don't want to manage 20 different CROs.
Right.
They want to consolidate their spending and form a multi-year exclusive alliance with just one or two massive providers like IQVIA.
Right.
On the surface, winning a multi-year exclusive contract with the top 10 pharma giant sounds like an absolute home run.
It provides incredible visibility for future revenue, which management loves to tout on their earnings calls. but it is a silent mechanical killer for profit margins.
Explain the mechanics there.
Consider the negotiation dynamics. When a massive pharmaceutical client consolidates their global spending with IQVIA, that client gains immense leverage.
Because they are bringing so much volume.
Exactly. They sit across the negotiating table and say, we are going to guarantee you $2 billion of business over the next 5 years. We are locking you in. But in exchange for that volume, we demand a 15% discount on your standard rate card.
Ah, so the revenue line stays incredibly robust, which keeps Wall Street happy on the surface, but the actual profitability of delivering those specific trials slowly degrades.
Yes.
The big pharma client is actively squeezing IQVIA's margins.
Exactly. And if their margins are already being structurally squeezed by these mega clients in a good economy, what happens to this highly levered foundation if the macroeconomic environment for biotech funding suddenly turns sour?
That's a scary thought.
Let's take those margin pressures and stress test the actual foundations of the company.
Let's do it. We need to look closely at the balance sheet risk, specifically a massive line item called goodwill. The memo notes that IQVIA carries a staggering $16.6 billion in goodwill.
$16.6 billion.
Now, for anyone rusty on their accounting mechanics, let's explain what goodwill actually represents. Let's say I buy a lemonade stand, and the physical lemons, the pitcher, and the wooden table are worth $100.
Okay, simple enough.
But I pay $500 for the business because it's located on the busiest corner in town and has a great brand name. That extra $400 I paid over the physical value is recorded as goodwill on my books.
Right.
It represents the premium paid for synergy and brand value.
That is precisely how it works. And when you are a serial, highly active acquirer like IQVIA, buying up data brokers and tech platforms over a decade, that goodwill piles up exponentially.
So they have a mountain of it.
But the accounting rules are strict. You cannot just leave that $16.6 billion sitting on the balance sheet unchecked forever.
You have to prove it's still worth that much.
Exactly. You have to periodically test that goodwill to mathematically prove to auditors that those past acquisitions are still generating the future cash flows you originally expected. If the acquired businesses are underperforming, you are forced to take a write-down. This is called a goodwill impairment.
It's essentially admitting to the market, we overpaid for these assets, they aren't as valuable as we thought, and we're wiping billions of dollars of perceived value off our books.
Correct. And the memo uncovers a very specific catalyst for this risk. IQVIA is changing its segment reporting structure in 2026.
Why does that matter?
They're absorbing a segment called contract sales into their newly named commercial solutions segment. Because they're shuffling the deck chairs on how they report their business, accounting rules will force them to reallocate and formally test that massive pile of goodwill.
Now, to be fair, IQVIA hasn't reported any major impairment losses recently.
They haven't, but no impairment yet is a vastly different concept than no impairment risk.
Very true.
If global biotech funding slows down, trial cancellations tick up, and IQVIA's overall growth decelerates just as they are forced into this massive 2026 reporting restructure.
It could be a disaster.
This highly levered company could face a multi-billion-dollar write-down at the exact wrong time.
Which naturally brings us back to the $32.7 billion backlog we discussed at the very beginning.
Oh,
You warned us earlier not to treat that number as guaranteed cash.
I did.
The memo goes further and explicitly calls out something it terms the backlog illusion. Unpack the mechanics of this illusion for us.
Yeah.
Why is a record-high backlog sometimes a mirage?
The illusion stems from a fundamental misunderstanding of what a backlog actually represents. Most investors assume a high backlog means safety, and their only fear is outright cancellations, like a client going bankrupt and walking away.
Sure.
But the true insidious risk to a backlog isn't just cancellations. It is fundamentally about the mix and the velocity of the clinical trials sitting within it.
What do you mean by the mix and velocity?
Well, the entire landscape of clinical drug development is shifting. We are moving away from simple, straightforward trials for things like, say, cholesterol medication, where finding patients is easy.
Because everyone has high cholesterol.
Right. Today, trials are vastly more complex. We are seeing a massive surge in precision oncology and rare disease trials. These require incredibly specific, hard-to-find patient cohorts scattered across dozens of global jurisdictions.
So finding a patient with a very specific genetic mutation of a rare cancer takes significantly more time and operational effort than finding someone with high blood pressure.
Exactly. When a trial becomes highly complex or when it faces unexpected regulatory delays in a foreign country, the timeline to completion stretches out drastically.
I see the mechanical trap here. So the revenue recognition mathematically slows down.
Yep.
If IQVIA books a massive $200 million trial for a rare disease, that full $200 million gets triumphantly added to the backlog today. Wall Street
The
cheers.
stock goes up.
But if that specific trial takes 6 years to complete, instead of the projected 3 years, because they are struggling to enroll those rare patients, the amount of revenue they can actually recognize in any given quarter drops in half.
Exactly.
The total backlog stays artificially high, projecting an illusion of immense strength, but the actual velocity of the cash flowing through the business is decelerating.
And that deceleration is devastating to margins because time is literally money in the CRO business. While that trial is dragging on for an extra 3 years, IQVIA still has to pay their clinical project managers.
Right.
They still have to pay the software licensing fees to maintain the data infrastructure. They still have to keep the physical clinical sites active and compliant.
The fixed costs are eating the contract alive.
Precisely. You end up in a toxic cycle of high headline bookings, flat actual revenue, and rapidly shrinking profit margins. The memo strongly suggests that any skeptical financial model must stress test a slow conversion regime, not just assume the backlog converts at historical rates.
And as if operational delays weren't enough, we have the regulatory risks compounding this dynamic. The FDA is continuously updating its guidance on how real-world evidence, or RWE, can be utilized.
And IQVIA's high-margin commercial segment relies entirely on the value of that real-world evidence.
If we connect this back to the broader picture of their moat, a major data privacy breach or a sudden tightening of FDA regulations regarding how patient data can legally be used to support a drug's approval doesn't just result in a one-time annoying legal fine.
No, it's structural.
It structurally and permanently reduces the return on their foundational data assets. If the FDA raises the compliance bar, forcing IQVIA to spend twice as much time verifying their real-world data, their cost to deliver those exact same insights inflates permanently.
That brings us to the most plausible, realistic bear case for the stock. The bear case isn't some dramatic apocalyptic scenario where clinical trials simply cease to exist and IQVIA goes to zero overnight.
Okay, so what is it?
It's a scenario the memo calls industry digestion.
Digestion, meaning the industry ate too much during the pandemic and now it has a stomach ache.
Essentially, yes. We experienced an unprecedented boom in biotech venture capital funding over the last few years. Money was virtually free, and every experimental molecule was getting funded.
This is a gold rush.
But now interest rates are higher, capital is tighter, and those same biotech companies are pulling back. They are delaying their pipeline decisions. They are actively shrinking the scope and geography of their trials to conserve cash. The industry is digesting the previous excess.
And in a digestion phase, when the total pie of available trial work shrinks, massive CROs are forced to compete much more aggressively on price just to keep their 93,000 employees busy.
Right. It's a race to the bottom on pricing.
Now, IQVIA's immense global scale undoubtedly helps them weather this better than a small regional CRO.
Yeah.
But we have to circle back to that $15.7 billion elephant in the room. High leverage, combined with a massive recurring amortization burden, means that any minor slowdown in the broader industry hits the equity value of the stock disproportionately hard.
Which is the perfect segue to the actual math. We have mapped out the fragility of the data moat, we have scrutinized the mechanics of their margin gap, we have analyzed the competitive threats, and we have stress-tested the balance sheet risks.
It's time for brass tacks.
Exactly. Now, let's get down to brass tacks. How does a skeptical professional buy-side analyst take all of these qualitative risks and actually price this stock? Walk us through the valuation framework and how an institutional investor might position a trade around this information.
The primary tool the memo uses to value IQVIA is a discounted cash flow, or DCF, model. For the uninitiated, a DCF model is essentially a massive mathematical formula that attempts to estimate exactly how much cash a company will generate from today until the end of time, and then discounts all of that future cash back to its value in today's dollars.
I will keep the math conversational, but the specific inputs to this model dictate everything. The memo's base case model uses a 9% weighted average cost of capital, or WACC.
WACC. What does that mean in plain English?
Think of the WACC as the required hurdle rate. It's the baseline return an investor demands to take on the risk of holding this specific company's debt and equity.
Got it.
The model then assumes that by the year 2030, IQVIA will stabilize at a terminal growth rate of about 2.5%, roughly mirroring global GDP growth, and that their long-term cash flow margins will settle in the mid-teens.
Those are entirely reasonable, unheroic assumptions. I mean, they aren't predicting catastrophic failure, but they certainly aren't predicting AI-fueled hypergrowth.
No, it's a very grounded model.
And when you run those slightly skeptical baseline numbers through the model, what exact price does it spit out?
The base case model implies a fair equity value of roughly $165 per share.
Which is incredibly telling, because as of the writing of this memo, IQVIA stock is trading on the open market at roughly $166 a share.
The convergence is striking. It tells us that the broader market is pricing IQVIA almost perfectly to this exact base case scenario.
So it's perfectly priced.
The market isn't blindly demanding 20% perpetual software-like growth, but it is absolutely demanding flawless, continuous execution of their current strategy. There is no margin of safety built into the current price.
So what does this all mean for the listener? It means IQVIA is absolutely not a buy it, put it in a drawer, and forget about it for a decade stock. Your entry price and how you size your position dictate your entire fate.
Yes.
Let's look at the asymmetry of the possible outcomes, because the leverage makes the math terrifying. What happens in the model if management executes perfectly versus if they stumble?
Well, in the bull case scenario, where global trial demand reaccelerates massively and IQVIA successfully utilizes their proprietary AI investments to drastically cut operational costs and expand margins, the DCF model implies a fair value of $278 a share.
That is fantastic upside. But what does the floor look like? What is the downside case?
If the industry digestion phase deepens, causing those complex trials to stretch out, and profit margins compress to around 12% as big pharma clients squeeze pricing, the massive debt load acts like an anchor on a drowning ship.
Oof.
The downside case model implies a brutal, violent drop to roughly $76 a share.
A drop from 166 down to 76. That is an absolute cliff. Over half the equity value wiped out.
And let's be explicitly clear. That massive downside volatility is entirely due to the leverage.
Because they are operating with roughly 3.6 times net leverage, any slight downward revision in their future growth expectations crushes the equity value. The math is ruthless.
Right.
The bondholders and the banks holding that $15.7 billion in debt have to get paid first no matter what. The equity holders, the people buying the stock at 166, absorb 100% of the shock.
This extreme structural fragility makes IQVIA's recent capital allocation strategy highly questionable, if not outright alarming, to a skeptical analyst.
Why? What have they been doing?
In fiscal year 2025 alone, IQVIA spent over $1.2 billion in cash repurchasing their own stock on the open market.
Wait, they spent $1.2 billion buying back stock at an average price of around $169 a share.
Yes, consider the logic of that decision. If a rigorous base case DCF values the company at 165, management was actively buying back their own stock at or above fair market value.
That makes no sense.
Why is a company with $15.7 billion in debt sitting on its balance sheet spending $1.2 billion to buy back fairly valued equity? A skeptical underwriter would aggressively argue that deleveraging, taking that $1.2 billion cash and paying down the actual debt would be a vastly safer, infinitely more value-accretive move in a volatile, high-interest rate environment where biotech funding is uncertain.
It feels like a fundamental misalignment of priorities. It looks exactly like management is prioritizing short-term earnings per share growth, because EPS gets a mechanical, mathematical boost when you reduce the total number of shares outstanding through buybacks over the true long-term resilience of the balance sheet.
That behavior is not accidental. It is structurally incentivized. The memo specifically notes that IQVIA's executive compensation structure is heavily tied to their adjusted metrics, specifically adjusted diluted EPS and adjusted EBITDA.
Incentives drive outcomes every single time.
If the executive suite is paid millions of dollars in bonuses based on adjusted metrics that conveniently ignore the massive amortization costs of their acquisitions, and those same metrics mechanically reward them for reducing the share count through buybacks, they will rationally continue to buy companies and buy back stock regardless of the mounting leverage.
So Given all this complexity, if you are an institutional fund manager digesting this memo,
Yep.
how do you actually construct a tangible trade around IQVIA? It sounds far too structurally dangerous to just blindly go long and hope for the best.
The report concludes by suggesting a highly defensive, heavily structured posture. If you truly believe in the long-term viability of their data moat and want to be long IQVIA, you do not back up the truck at 166.
Start small.
You start with a very small exploratory core position. You size that position mathematically so that if the catastrophic 50% drawdown to 76 actually materializes, your broader portfolio easily survives the hit.
That's smart.
You only add capital to the position later if you see concrete quarterly evidence that backlog conversion speeds are stabilizing and that the management team is actually paying down the leverage.
But there is another way to play this, right? The memo mentions utilizing pair trades to hedge out the macroeconomic risk. Walk us through the mechanics of a pair trade in this context.
A pair trade isolates the specific thesis you want to bet on while canceling out the broader industry risk. Let's say you deeply analyze the CRO sector, and you conclude that IQVIA's 68 petabytes of integrated data truly is an insurmountable competitive advantage.
Okay, you believe in the moat.
Right. But you are utterly terrified that a recession will cause a broad collapse in biotech venture funding. To execute the pair trade, you buy IQVIA stock going long, but you simultaneously short a weaker distressed CRO competitor such as Fortrea.
I see. So if the entire biotech sector tanks due to a macroeconomic recession, IQVIA's stock drops and you lose money on your long position.
Yeah.
But because Fortrea is a fundamentally weaker company, its stock drops even harder. The profit you make from shorting Fortrea mathematically offsets the losses you take on IQVIA.
Exactly.
You have successfully isolated your bet on IQVIA's specific competitive data edge while completely neutralizing your exposure to the broader macroeconomic cycle.
That is a masterclass in institutional risk management.
Okay, we have covered an immense amount of ground today, diving deep into the plumbing of one of the most complex companies in the healthcare space. Let's distill this comprehensive analysis into the core takeaways you need to remember.
Let's recap.
First, IQVIA is undeniably a cash-generating behemoth with a unique, deeply integrated model spanning clinical trial execution to commercial launch. But their $15.7 billion debt load, built through a relentless roll-up strategy, makes their equity incredibly fragile to any macro shocks or trial delays.
Second, their heavily promoted healthcare-grade AI narrative is a structural double-edged sword. While AI promises internal operational efficiency, the rise of powerful open-source AI simultaneously threatens their core pricing power. It lowers the barrier to entry, allowing pharmaceutical clients to bypass IQVIA's premium analytics and analyze the raw data themselves.
Third, do not fall victim to the backlog illusion. A towering $32.7 billion backlog is a helpful directional indicator of future demand. But shifting trial complexities, like the rise of precision oncology global regulatory delays and outright cancellation risks, mean that backlog is far from guaranteed cash in the bank. Slower conversion velocity acts as a silent killer of profit margins.
Fourth, at roughly $166 a share, the stock is currently priced for near perfection. It offers limited upside relative to the massive structural risks, leaving substantial downside risk, potentially dropping into the 70s if the CRO cycle enters a prolonged digestion phase, or if their 2026 segment recording recast forces a multi-billion-dollar goodwill impairment.
This brings us all the way back to the image we started with. When you look at IQVIA from a distance, you see a towering financial monument. The revenues are in the tens of billions, they control the data of 1 in 8 humans, and they are entrenched in the most critical industry on Earth.
It looks unbreakable.
But when you examine the foundation, you realize it rests on some incredibly dynamic, unpredictable, and highly levered fault lines.
Which leaves us with one final lingering question to consider as we close, a question that goes far beyond the financial spreadsheets.
What's the question?
Consider the ultimate vulnerability of their business model. IQVIA's entire proprietary data empire, the fundamental competitive moat that justifies their existence, rests entirely on the legal definition of de-identified data. As global privacy laws aggressively evolve, and as the era of AI makes re-identification algorithms exponentially more powerful, what happens to a multi-billion-dollar data monopoly when the very legal definition of anonymous changes overnight?
Something to carefully mull over the next time you look at a healthcare tech valuation. Thank you so much for joining us on this deep dive. We'll see you next time.